Welcome, everyone. I'm Sharon McLennan, and today I want to share some key insights that I think it's important for every home seller to have before making the decision to sell their home. Whether you're selling your primary residence, downsizing, or just planning for the future, you'll walk away from this session with a clearer understanding of some of the financial consequences that are not generally well known that go along with selling your home. So without further ado, let's go ahead and dive in. Before going any further, I just would like to give you a little bit of brief background about myself so you'll know what the vantage point is that I'm speaking to you from. I have been a licensed real estate practitioner in Florida for over 25 years, and I have been on all sides of the transaction. I've been a listing agent, a buying agent. I've been a buyer myself, a seller myself, as well as a property manager for both residential and commercial properties. I'm also a licensed CPA and property manager, and that's when I realized that there are so many aspects related to buying and selling real estate that a lot of times clients are not aware of and do not focus on. These aspects can have a significant difference on your underlying financial results, and so the goal today is to share some information that will help you to get a better handle on what the other implications are, and so that you can make the best possible decision for you and for your circumstances. My goal today is not to give you legal or financial advice, but rather to give you some insights into some of the areas that you should explore with your legal and financial advisors. While every effort has been made to make sure that the information that you're receiving is accurate and helpful, bear in mind that real estate transactions are complicated and very, very nuanced. And so it's always a good idea to go ahead and make sure that you get advice from your legal and financial advisors that are specific to your circumstance and not general information that is provided for informational purposes only. So let's make sure that you use this information as a springboard for ideas and topics that you really need to explore further with your financial professionals, and not use this as legal or financial advice, because that's not what it's intended to do. So let's take a look at the aspects that we're going to cover for today's webinar. The first thing that we're going to talk about is understanding net proceeds and how that differs from your sales price. We're also going to spend some time looking at capital gains and how that is calculated. And I will warn you from now, there are a lot of numbers. We might get a little bit in the weeds, but I'll do my best to make sure that you get an overall understanding of the concept and just have a fair idea of what to expect and not get too deep into the weeds, but there will be some math involved. And then we will also talk about portability, because that's something that I find a lot of sellers are not aware of, and this can go a long way to unlocking you from being trapped in your home because you are concerned about the implications of property taxes that you might incur if you were to move to another property. So those are the three financial concepts that we're going to talk about. Once we've gone through all of that, we will just evaluate in very general terms what those concepts actually mean, what that breaks down to in terms of overall impact. And then last but not least, we'll go through some of the questions that you should most likely ask your real estate agent to get the information that you need as you're making that decision and evaluating what your options are ahead of listing your home for sale. Many sellers get really excited about the sales price, and while I'll be the first to admit that the sales price is important, I think one of the things that should be a more dedicated focus is what your net proceeds are going to be. And your net proceeds are actually your sales price, less any expenses related to the sale of the property, less any outstanding debt like mortgage payoff or outstanding tax bills. All of that gets factored into the calculation of what your net proceeds are going to be. At the end of the day, your net proceeds is what you actually get up from the table with. That's what you're going to be walking away with. And that to me does not get enough attention from home sellers as it should, because we're more focused on the sales price. Again, sales price is important because that's the top line number, but I think one of the things that I advise my clients to do is to make sure that they focus not only on the top line number, but also look at the bottom line number as well. Because at the end of the day, as if the popular saying goes, it's not what you get, it's what you keep. Some of the common closing costs that you can expect to pay that will actually contribute to your expenses and reduce your sales price to get to your net proceeds in Florida is, of course, realtor commissions if they're involved. And that again is a point of negotiation in our current market. Sellers can negotiate with buyers in terms of who's going to be paying what commission to which agent. Real estate commission is always negotiable, and as a seller, you do have the option to negotiate your commission with both the seller's agent and the buyer's agent if you choose to make any compensation arrangements with the buyer's agent. So always bear in mind, real estate commission is a part of the expenses related to selling the property, and it is absolutely negotiable. So make sure that you're focusing on what that is and who's paying what. Also, you can expect to pay title insurance and dock stamps. In Dade and Broward County, which is where I primarily work, title insurance, the title company is picked by the buyer, and they typically pay for their title insurance. In other parts of the state, Palm Beach and up north, what we find is that the seller is the one who typically picks the title company, and so they end up paying for the title insurance. So depending upon where you are, this could be a cost that will show up, but in any event, this is something that you should be aware of, and you can be on the lookout for on your estimated closing statement, so that you can have an idea what it is that you're going to be paying. Also, any HOA fees and transfer costs, those typically are borne by the seller. And again, in real estate, almost everything is negotiable. So there may be a request to pay for some of repairs on the property, or to make some concessions to make the buyer help the buyer put their deal together to make that work. That could also be a part of your closing costs. The key takeaway for all of these items is that these items can all be, for the most part, negotiated, and it can be decided who pays for what. So again, you have significant control over what is going to be taken out of the net proceeds of the sales price that you're getting at for the property to arrive at your net proceeds. So do keep that in mind. The next topic that we're going to be talking about is understanding capital gains tax, right? And it's important to understand that the IRS will allow you to exclude a portion of your gain if you meet specific conditions. The cutoff, the threshold for the exclusion is $250,000 if you're filing as a single person on your tax return. If you're married filing jointly, that exclusion is up to $500,000, $500,000. So it's important that can have a big impact on what your ultimate tax bill is going to be from the sale of your home. The key thing to keep in mind is the IRS will allow you to exclude that first $250,000 or $500,000 if you meet the 2 out of 5 rule. And so what that means is, for the last 5 years, if you lived in the property for 2 of those years, not necessarily the last 2, but 2 out of the last 5 years, then you would be eligible for the exclusion and not have to pay taxes on that first $250,000 or first $500,000, depending upon your tax filing situation. Now the big question is, well, how do you calculate your gain? And this is where a lot of sellers get confused. And the gain is really calculated taking your sales price. So whatever the sales price of your property is, you're going to subtract your adjusted basis, which is a tax term. And we're going to talk a little bit about what that is, and that will result in your gain. So sales price less adjusted basis is equal to your gain. Now, what is adjusted basis? Adjusted basis is the cost for your property when you acquired it, whatever your cost was that you incurred to acquire it. Your basis would also include this any of the additions or upgrades that you may have made to the property over time. So for example, if you put a new roof on the property, or if you redid the kitchen, did some type of a renovation, the costs associated to that would be included as a part of your overall acquisition price, your value. So that would be considered a part of your adjusted basis, and that would be added on to be included in your net gain calculation. Bear in mind that what increases your basis is any renovations, any capital repairs, you updated or redid your furnace or your HVAC system, any major landscaping improvements, you put in a pool, anything like that. The costs associated with that would be added to your basis. What decreases your basis is things like depreciation, which is not really applicable if you were living in the home. If it was your primary residence, you would not have taken depreciation on it. If it was a situation where you rented it or it was an investment property for a part of the last 5 years, or at any point that you owned it, again, this is one of the things that I was talking about when I said that real estate is super nuanced, and so it is really important for you to get information that's specific to your circumstance. That is something that would require a little bit more explanation than I'm prepared to give during this webinar, but bear in mind, if that is your situation, that's something that you want to bring to the attention of your tax advisor or your legal counsel that's helping you prepare your calculation for your tax return. So bear that in mind as it relates to depreciation. Another thing that would also reduce your basis is if you had a casualty loss that you already deducted from your taxes, that would have reduced your basis, as well as if you got insurance proceeds for any of the improvements, if you were reimbursed, that also would reduce your basis. So keep that in mind. Again, not stuff that I recommend you trying to figure out on your own. Make sure you get the appropriate level of advice that you're going to need to be able to move forward and to be able to make the best decision, the right calculation as it relates to capital gains on your property. All right. One of the things that I like to do, because I realize that we're having a very theoretical conversation here, and one of the things that I find is typically helpful to bring the concept to life is just to use some simple numbers to help in the explanation. So say we have a case where you are selling your property for $600,000, but your adjusted basis is $400,000. You bought it for $350,000. You did $50,000 worth of capital improvements. You put in a pool. You put on a new roof. All of this got rolled up into your adjusted basis, and now you're looking to sell. Your capital gains would now be $200,000. That's the $600,000. That's the $400,000. That would be your $200,000 tax bill. The good news is if you meet the exclusion that the IRS has, that $200,000 gain would now be tax-free, because the first $250,000, if you're filing single, would not be subject to tax, and the first $500,000 if you're filing married. So in any case, $200,000 would be below the threshold, so this would be something that would not be subject to taxes because it would meet the exclusion. When you take into consideration that the average capital gains tax rate is somewhere between 15 and 20%, and income, the regular earned income tax rate can be even higher than that. 20% of $200,000 is $40,000. That's an immediate tax savings that could have a significant impact on your overall financial results at the end of the day. So keep that in mind. make sure that you're clear on the inclusions, on the exclusions, and make sure that you factor that into the timing of the sale of your property. So if you've been in a house for 18 months and are thinking of selling, you may want to wait the additional 6 months so that you could meet the 2-year criteria to be able to get that exclusion, because it can have a significant impact on your bottom line. All right, the third concept, the third financial concept that I said we would talk about is portability. And what portability does is Florida's benefit allows you to transfer your homestead property tax savings to your new property. What does that mean in real terms? One of the big benefits of the Save Your Homes tax benefit, I guess is the best way to describe it. One of the big benefits is that when you file homestead on a property, your appraised tax rate, the basis for the appraisal for your property taxes, can only increase by 3% every year. That's the max. It can't go up by more than 3%. And what has happened in Florida, and particularly South Florida, where we've had years with appreciation 7, 10, 15, sometimes even as much as 20% year over year on property values, the value of the property has gone up, but the basis that the appraiser uses to calculate your taxes can only go up by 3%. So over time, what that creates is a huge disparity between what you would pay for property taxes at the current market rate versus what you're actually paying because you've been in that property for many years now, and over time, even though values have gone up, say for example 10% every year, your property taxes have only gone up by 3% every year. The appraised value that they use has only gone up by 3%, so there is a big tax savings that you as a longer term resident are being able to take advantage of. Now what we found is that a lot of folks were interested in maybe selling and buying another property, but because if they bought at current market value, they would end up paying a much higher property tax on the new home. In many cases, even if it was worth less, they found themselves locked in and deciding that they really didn't want to make the change. Financially, it didn't make sense for them. So portability is a way where you can actually take your savings, say your property appraises or can sell for $500,000, but you're only paying taxes on $250,000 worth of your value. That is a $250,000 tax savings that you have available, that you're just being able to take advantage of every year. Under portability, if you sell that home and purchase another home within the next 3 years, you can transfer whatever that savings is that you were experiencing for that previous residence to the new residence. So essentially, you bought a home for $600,000 and you have a tax savings on your previous home of $200,000. That $600,000 home, you would pay property taxes on only $400,000 worth of value, because the same $200,000 savings that you were being shielded from on the original property, you can now take advantage of on this new property. The big benefit for this is homeowners are no longer locked into their home because property taxes make it unaffordable for them to leave one property and move to the next one. And as I always say, I like to use actual numbers to be able to illustrate the point. I think it makes it a little bit clearer. So let's take an example of you purchased a home for $150,000, right? That was what you're paying the taxes on. That's the assessed value. You probably paid for a little bit more than $150,000 for it because there's some exemptions that we get when we file for homestead. But say for the sake of argument and for simplicity, you're being taxed at $150,000. That's what's being used as a value for your home to calculate your property taxes. But the true value of your home is $350,000. Because of Save Your Homes, you now have a $200,000 Save Our Homes benefit that you can now apply to a new property. So say you bought another property for $400,000. Again, that $200,000 can transfer to this new property, and now instead of paying taxes on a $400,000 home, you would only be paying taxes on the $200,000 assessed value because you transferred your Save Your Home benefit. That is a huge deal and can have a big impact on an ongoing recurring expense, because remember, we pay property taxes every year. So to the extent that you can transfer that benefit and keep going, that exclusion will stay in place as long as you claim your existing homestead, your new homestead exemption in this new location, and for as long as you own that property, that $200,000 will have been permanently taken off the record as far as your home is concerned. And now the new home will continue to build its own tax savings, because the values will go up and the property itself will be assessed at this lower rate, and so on and so forth. But as you can see, that can be a significant savings as it relates to your overall ongoing expenses in the, as for the future purchase. Again, something to keep in mind: if you're selling to buy something, you want to make sure that portability, if you are entitled to it, is something that you absolutely take into consideration. So the real financial impact of selling, I told you I would cover it. What we're looking at is the net proceeds, right? The actual cash that you're going to receive after your expenses related to selling. This is your buying power for your next move. The tax implications, super important to make sure that you take advantage of whatever capital gains exclusions may be available. Make sure that you're evaluating timing to be sure that you're not just missing the opportunity to take advantage of what could be a significant exclusion in terms of capital gains tax on the sale of your home. You'll also want to take into consideration portability, the timing of it. Remember, it's 3 years. You have to buy in the state, so you want to make sure that the timing makes sense for you based on what your overall plans are to be able to leverage that portability. And then, of course, you're looking at replacement home costs. That's not something that I identified as a talking point earlier in the webinar, but if you're looking to sell and then buy, that is going to be a factor. Of course, the fact that you're going to be able to port some of your tax savings to the new property, that will help as you're evaluating how affordable or how much sense it makes for you to make that actual transition. All right, so there are some key questions that you want to make sure that you ask your real estate agent so that you get as much information as possible as you're doing your analysis and as you're referring back to your legal and tax and audit advisors. So you want to make sure that you ask the agent for an estimate of your net proceeds, because at the end of the day, it's not what you get, it's what you keep that matters. So you want to ask for the net proceeds. In our office, we have a worksheet that we can quickly use to calculate for you what an estimated net proceeds amount is going to be. We typically ask for you to give us your mortgage balance, an estimate of that, and we can factor all of that into the calculation so that you can know exactly what you reasonably can expect to walk away from the table with as it relates to the sale. You want to also talk to your agent. Again, I like to look at real estate as a place to live, obviously important, but also it should multitask for you. That's one of the reasons why I really like real estate the way that I do as an investment vehicle. Because another question to ask your agent is the timing right for me to sell my home? Should I consider renting it out if renting it is an option for you? Okay, so there are many, I've worked with many clients who have not had to sell a home to be able to purchase something else, or who maybe are not quite ready to purchase right now. They're thinking about the possibility of renting that out. That may be an option. Of course, as you're evaluating that, you want to keep in mind that you have to get the capital gains exclusion, you want to be sure to consider what time frame you would be renting at, so that you don't put yourself out of contention for that 2 out of 5 rule, to be able to avoid paying capital gains tax on at least the first 250 or $500,000 of your gain. So you want to keep that in mind. You could also ask your agent about portability. Is that a factor for you? They should be able to give you a real honest assessment as to what your savings are approximately, what is your appraised the appraised value that the property appraiser is looking at, the assessed value that the property appraiser is looking at in evaluating your home and calculating your taxes, comparing that to market value. That is where we calculate what the true tax benefit is of the Save Our Homes exemption. So you want to have an idea what that is, because if you're thinking about making another purchase and you're concerned about what the future tax bill could be from that purchase, knowing what savings you can port to the new home, that could make a big difference. And of course, just ask them to connect you with, give you the information, any information that they think you might need to understand the tax implications. Bear in mind, not all real estate agents are CPAs, so that's not necessarily something that you're going to be doubling down on, but just ask the question, hey, are there any tax implications or other financial implications that you can think of that I should be concerned with as a part of this transaction? And hopefully they'll be able to give you some additional insights so that you can make the best possible decision for you. At the end of the day, that is what the goal is, to make sure that we get you to a place where you're making the best decisions for you. Okay, so let's talk about your situation. If you want to schedule a free seller strategy call with me, I'm happy to do that. I'm happy to go through all of the areas that we discussed. We can do an estimate for you on your actual net proceeds. I'm happy to review your portability benefits, and I help you understand any potential tax implications on your sale. I can also help you to talk about strategically when's the best time for you to sell. So let's go ahead and crunch your numbers. It's an absolutely free consultation. There's no obligation involved. Let's go ahead and crunch your numbers before you list a property, so we make sure that you are in the right place, making the right decision, getting the maximum impact from your sale. I hope that you found this information helpful. Thank you for attending the webinar. If you require additional information, or there's other ways that I can help you, please visit my website, which is simplyaskSharon.com. On that website, I have information on free resources. You can also schedule a consultation with me. It'll put you directly in touch with my calendar, and you can pick a convenient date and time for you that we can talk about what the specifics are about your situation. I thank you for attending. I hope you found it useful, and I look forward to catching up with you in a future webinar. Take care.